You are listening to the Marc Guzman podcast experience. So let's get into the property analysis now. And what building do we have, Brian?
So today we're going to look at a 10-unit building in the city of Pittsburgh. Now, many of you'll probably hear me talk about how we'll do analysis on individual single-family homes for clients and make recommendations on trading those lower performing or low cap rate performing properties into larger multi-units that not only have better cash flow, better cap rate to start, but also the ability to wipe out any taxable income through depreciation. So the property we're looking at today is a 10-unit building in the city of Pittsburgh, and the property was built, I think, in 1948. Now, the primary things that I'm looking for here is the fact that in Pittsburgh, and correct me if I'm wrong, but there's no rent control.
That's correct.
And it's a 10-unit building asking $1,925,000. In particular, I have a 4-unit building in the city of Richmond that's currently in escrow, and we're in contract for a little over $800,000. And the client has a humongous capital gain. In fact, I sold the client the property 19 years ago. 19 years ago. Yeah, just to kind of date myself. But regardless.
So they're doing well in the sale?
They're doing well in the sale. In my opinion, they held on to it a lot longer. In fact, as we were going through their analysis, they did realize they could have made a lot more gains and moves throughout the year. Some of my other clients did, where I traded them into, they're into like several hundred units now. But this particular client's unloading an 4-unit building. And part of the things that I'm looking for here is that they're going to have the ability to buy a larger multi-unit with the money that they're going to be netting from the property, while simultaneously being able to satisfy the requirements or the minimum requirements of their 1031 tax deferred exchange. So in particular, this one I'm looking at right here is a 10-unit building in the city of Pittsburgh. It's asking $1,925,000. When we looked through the offering memorandum and the expenses of the property, it supported a loan amount of $1,260,875. So in this case, they would require about a 34, almost 35% down payment. Long story short, between the down payment and the closing cost, the client's going to need about $701,000. Now, this happens to fit the bill with what they're going to be netting. In fact, they're going to be netting a little bit more than this, so that we're actually planning on using the excess portion to help them buy a single-family home and things of this nature that they might later turn into their primary residence. But that's a story for another time. This 10-unit building requiring about $701,000 down, which is roughly a 65% loan to value, in my opinion, has a good, strong potential because of the fact that it doesn't have rent control. After really hammering through the expenses, which are ranging around 38% of the effective income, the property still starts out at a decent 5.14 cap rate. Now, when I analyze its current income versus the market rent is actually about a 17.89% difference, right? Or a loss to lease, meaning that they could rent the property if everything was rented out at current market value for 17.89% more, right? So
what would be the equity gain on that jump?
That was what I was going to get to. So, for example, if they get into a property like this with $1,925,000 with a 35% down, just by simply getting it to the market rents, they're experiencing roughly a $690,424.89 capital gain. So in addition to the money they came in with the gain from their fourplex sale, they're going to potentially ride this property up to a $690,000 capital gain, which of course then puts them in a potential, if they sell this 10-unit, to turn it into a 20 or a 25-unit building, greater income, greater depreciation. Now, that 17.89% loss to lease, right? One of the things you always want to look out for is the fact that you can't just, like 20 years ago you can't just jump the current rents right up to the market rents, because that would be a really high jump. And so one of the things I always like to analyze when I'm looking at these things is if I were to, I see the big jump between the current rent and the market rent is I go back and I started out at the current rent again, and I apply a 10% rental increase. So in other words, the current rent is about $13,715. If I were to apply a moderate rental increase of 10%, which is not above the gouging the gouging clause that's currently going around with the rent increases because of the various disasters that have occurred in California, just that 10% rental increase, raising the rents from $13,715 to $15,086, whereas you can go as high as $16,700. That in itself creates a bump in equity of $345,000, $345,781 of value. So if they're coming in at a acquisition price of $1,925,000, the property is still going to be valued roughly about $2,270,000 if you are using a prevailing cap rate of 5 or 6%, I'm sorry, 5.5%. And again, to put things in perspective, cap rates are the average return that most investors are willing to pay or make whenever they buy a property. The higher the cap, the lower the price. The lower the cap, the higher the price. So if we're using a middle cap rate of 5.5 to 6, then we're still seeing a tremendous equity jump. Now, what that also means for the buyer is coming right into the property with the existing rents. They're actually seeing a cash flow of roughly $1,663.63, which is roughly $20,000 a year. And after paying a principal reduction, they're actually coming into a 5.56% ROI. Now, again, the difference between ROI and cap rate is that ROI takes into consideration the actual money that was taken out of pocket to acquire the property, as opposed to cap rate, which considers that you bought the property all cash. The property at a purchase price of $1,925,000 creates about a $56,000 depreciation schedule, which totally offsets the $38,999 of taxable income that the property produces. So it creates a $17,000 additional depreciation write-off for individual investors who might be in the position to use it. Now, not all investors can use it because of their various employment status, such as if they're gainfully employed versus self-employed, and if they're technically in the business. But regardless, even if they didn't have to pay the taxes on the $40,000 they're initially starting to make, it's still a huge win. And then, of course, as you start to ratchet up the rents, just with these moderate rental increases of 10%, you are not only increasing the value, but you're still within a range of about $56,000 a year that you can make. Again, keep in mind that starting out, you're making $40,000 a year, not having to necessarily pay tax because of the depreciation the property will put off, and you can bring the income all the way up to $56,000 before a taxable event on the ordinary income from the rents actually occurs. So again, these are all various wins that I'm looking for whenever I'm looking at placing my clients, taking them into another property after selling a smaller property or a relinquished property from a 1031 tax-deferred exchange. And again, the big part of this is as I'm going through all these various rental increases, which I'm predicting to take roughly about 2.5 to 3 years, that within 3 years after raising the rents just in these moderate levels from $13,715, again, 3 to 4 years later, bringing it up to a grand total of about $18,254, you're creating roughly $1,022,000 of equity in that property if you sold it at a 6 cap. So if the market starts riding again very well and people are buying at a lower return, say a 5 cap, then that $1,022,000 capital gain could be a whole lot more. So anyways, I'm going to stop here and analyze this property a little bit more for my client, and stay tuned next time. And I was thinking next time what we could do is we could actually do an analysis on one of these deals that we've actually closed, where we demonstrate how we take a single family residences that are usually used for rentals and trade them into multifamily units and the various things that are going on.
Yeah, we've been toying around with a few ideas on how to do this property analysis a little bit more, or or add a little bit more style to it. And I think what would be really fun to do is an analysis on site at a property, and possibly even a walkthrough where we kind of point out some management from a management perspective what needs to be done in
Yeah.
order to correct and actually fix a property in order to get higher sales price and higher rents. So with that said, thank you for watching Keeping It Realty, and big shout out to East Brother Beer Company again for being the show's sponsor. Definitely go check them out May 5th from 1 to 8 p.m. in Point Richmond. I will be there. It's a taco cook-off. You can't go wrong with tacos and beer. You
No,
simply
you can't go wrong with tacos and beer, and that's coming from somebody that tries to stay away from too many tacos and beer.